Hello, everybody. This is Tim Gregory from Vermeer Investment Management. I'm on to make another video recording with my colleague Charlie Fricker. We've made a series of these over the last year or so in what obviously has been a very tricky environment for global equities. Just as a reminder, or for those who don't know us, we run a global long-only equities fund with about 60 names. Been doing so for about 6 years. Obviously, this has been a tough year, both because of bear markets and so many difficult positions to understand how they were playing out given the aftermath of COVID. And no more days more tricky than yesterday, Charlie, when we, I guess, finally got a piece of inflation data out of the US that was better than investors had been expecting, and an astonishing reaction, although maybe not that astonishing given how people are positioned that followed that. But maybe let's just dig in a little bit first to the inflation data, and I'll let you start off there, Charlie.
Yeah, I think it's interesting. It followed the Federal Reserve the other week, there was a lot of the markets have been bouncing on the potential kind of shift in narrative around the degree to which the Fed would hike rates moving forwards, and that led into the Federal Reserve meeting the other week. The Fed ended up hiking 75 basis points. I mean, larger scale, it's amazing to think back to the end of last year when I think the market was only pricing in 3 25 basis point hikes across the whole of the year to end up at 0.75. And we've had, I think it's now 4 75 basis point hikes in a row to see how fast things have shifted. But the statement they put out was, I suppose you could call it a bit more dovish. Market latched onto that. And then Powell at his press conference pushed back and was a bit more hawkish when he talked about the terminal rate being higher than previously expected. Markets went lower on the back of that. And then, as you alluded to, running into the inflation print yesterday, I think the market was looking for a lower than expected number, and it got a lower than expected number for both normal CPI and for core CPI. But I think it's important to remember it was only, I think, the third time in the last 20 months that we've had inflation come in below expectations. So whilst the market did rally aggressively yesterday because it was the first piece of good inflation data and good news on that front we've seen in a long time, the context of things I think is still important about, is that print going to change what the Fed's going to do? Does it really change anyone's view on where rates might end up and what longer term inflation is going to be, and ultimately where it settles down when it does roll over? I don't think anything yesterday really changed that. But to your point, the narrative was anything that's lower than expected is going to be better, and the market really latched onto that. And I think when you look in through the data, there are some positive signs in there. Goods prices are extra fuel and energy part, I think, starting to roll over a bit, which is encouraging. A lot of the downside surprise was driven by health insurance costs in the US, which drove quite a significant part of the downside. But we are seeing airline prices, used car prices, the stuff that people expected 12 months ago to start rolling over, now starting to kind of roll over a bit. But the shelter part that is sticky still remains quite high, around 0.8. Inflation did roll over a bit. So within the data, positives and negatives, but it's definitely a step in the right direction. And the market really latched onto that, didn't it?
Yeah, and just to be clear, Charlie, I mean, I, as you say, in terms of our expectations from the Fed and changes in policy, I think we're agreed that we don't really expect there to be any changes to policy. But I think interest rate futures priced out a 75 basis points hike at the next meeting, which had been broadly hinted at that last Fed meeting, had it not anyway.
Yeah, so it's gone down to, I think we're at 50 basis points priced in for the last meeting of the year in December. I think we've taken out basically 25 basis points across the curve. So I think the terminal rate's now priced in around the 4.75 to 5 range, whereas it was, I think 5.5 plus at one point over the last few weeks. So I think our view has been that it's going to be the rates, how long rates stay at the level they end up at, rather than exactly where they end up. It's going to be how long they stay there and where inflation settles down at, whether gets all the way back to 2 as the central bank wants, or whether it sits at that kind of 3 to 4 level over the longer time, I think remains the question now.
And our concern on that has been that the likely persistent rate of inflation might get that job of getting down to 2 more difficult, and what actually might. So, we've been saying we thought that rates might perhaps not get as high as some people fear, but may then stay at flat level for some time after that. And I guess what we think would change that would be a significant shift in employment, which would lead to a dual mandate that the Fed now has kicking in, of which there is no sign whatsoever currently. Because as we know, whilst we've been hearing about job losses in what ironically have been some of the great go-go growth stocks of recent years, like Meta and Amazon announcing potential cutting yesterday, you know, we're still hearing about job shortages in other sectors of the economy. So, you know, I think that is a long, long way away from the Fed having to shift to its dual mandate of looking more closely at the impact on unemployment, notwithstanding the fact that history does tell us when economic slowdowns occur in the US, they can cut costs very quickly. So obviously that's something we have to look out for.
I think circling back on your point on the Fed, it's interesting that if you look back at prior videos we've done, we've talked about this switch between when does the focus shift from inflation to employment a lot, and what unemployment would need to get to get the Fed worried again. We've talked about they've got to probably get near a 4.5% before they start to really worry about that. How that shifts moving forwards, I mean, you alluded to it there, that the difference between US and UK European labour markets is the US companies can cut their labour force very, very quickly without having to go through a lot of the consultation and legal processes you do over in the UK and Europe. And you've seen that from the big tech companies, as you said. And I think flicking to earnings season, which is also just finished, it's been a very busy 2-3 week period. It's interesting, if you'd have said a year ago that Meta was going to fall 25%, Amazon, Microsoft, Alphabet were all going to fall 8 to 10% on their earnings, announcing job hiring freezes and all that kind of stuff, and you'd say the market was going to trade higher on pretty much every day that those numbers came out. That's a very different scenario to where we were a year ago, when the market would have really, really struggled on the back of announcements like that. In what was an overall, I think, earnings season that was probably a bit better than we maybe thought it was, wasn't it? Or may have.
I mean, a real mixture is the answer. A real mixture. And obviously, as we've said any number of times, the fact that Apple, Amazon, Microsoft, Meta, Google make up such a big percentage of the benchmark, they're always going to have a bigger impact on the overall market. But to your point, markets held in reasonably well, despite some disappointing numbers from those companies and some big falls in those numbers. I mean, the exception, of course, was Apple, which continues to show great resilience. The shares were up 7% on results, fell back thereafter, but were up 9% yesterday. So it has been a very mixed bag in the earnings season. And I think one of the things that has been noteworthy to me in the season is that those companies who've dared to give conservative guidance inevitably going into 2023 have had quite a rough time of it. It has not rewarded, analysts love companies to give guidance. I'm not saying no companies, most companies that have been brave enough and therefore cautious going into their results briefing and giving some form of 23 guide have had a rough time of it. I'll give you an example of that, Charlie. Say Danaher, which we often hold up as a model company. They had great results. Shares were up in pre-market on the call. And then when they were asked about 23, and they highlighted the fact that they had $800 million odd of US dollar headwinds on revenue next year, plus a COVID cliff from their testing business to be about 200 or 300 million. The shares got sunk. And, it's pretty harsh, really, because, inevitably people are going to give a guide. And if you didn't give a guide, you seem to get away with it a little bit. Yeah. So a real mixed bag. I think banks' earnings were broadly better than expected, and JP Morgan stock's done really well since those numbers, although it actually went down on the day of its numbers, but it's done really well since. But banks' numbers were pretty good in general. Big tech was a disappointment. Chip stocks, interesting. Some chip stocks that have reported bad numbers, bad guidance. Stocks have been hammered this year. One or two stocks went better on their results. For example.
Yeah, and it's as we kind of internally, we've been talking about what we'd be looking for. So our cash position is still reasonably high, and we have been putting some to work. But that idea about stocks rallying on massive guidance cuts for next year, and you've seen that in the chip space. Micron had terrible numbers and a terrible guide. That stock bounced on its numbers. AMD the other week reiterated their previous pre-announcements about missed earnings, but their guide was a bit mixed. That stock traded higher. Nvidia's had a couple of warnings, and they were up 14 odd % yesterday. So as you said, it's that narrative that some of who've dared to go early and maybe have held up a bit better in terms of the guide got hit up, whereas the chips, which has been a really, really tough space this year, giving some colour that people can now frame their narrative around has helped them a bit, isn't it?
Yeah, I think that's right. I mean, to give the context of that in terms of chips, I think Nvidia has rallied 35% from the lows and is half what it was a year ago. Yeah. Give or take. I know that won't be 100% accurate, but so it has been a mixed results season. I think net overall, and of course the skew of bias comes from the weightings of those big stocks that disappointed, although Apple did not disappoint. And we continue to have quite a large holding in that. And I think the other thing that is really tricky and takes me back 20 odd years or so ago to the big tech burst of that era, that one thing you've got to be very careful of, in this post-COVID environment, because it is really hard to work out where people are in their cycles post-COVID, what's been pulled forward, what's been delayed. Zimmer's a good example of that in the hospital, procedure space, how far procedures have got to catch up, things like that. It is really difficult to really evaluate what's happening in that respect. And I just remember 20 years ago, a big mistake that investors made, that as companies had terrible results and shares went down, people sold them and bought the stocks of those things that were currently still resilient, only to find that as the recession got deeper 6 months down the track, they were then having the warnings and they'd cycle out of some things out at the bottom, only to cycle other things that were held up better and then didn't hold up so well. So you've got to be really careful about that and tiptoe around those issues. And it is tricky because these are unprecedented times because of COVID. We really have not been here before. And we're all, there's no playbook really for this in the sense of how fast will supply chains unlock, how fast will some things that have been really inflationary change, how fast will labour forces adjust, what's happening to wages. All those things are still very much in the mix. And of course, how far will the economy slow? Because if we go right back to the start of our conversation and the Federal Reserve, the first part of the Federal Reserve's commentary on that 75 basis point rate hike was them beginning to acknowledge that they had done a lot very quickly. And it might just now be time to go a bit slower to see how much those rate hikes are having an effect. And, to see how far inflation does come down as we cycle some prices starting to slow a little bit. And that's very much in the mix as well, isn't it? And then, of course, just for good measure this week, Charlie, yesterday, the S&P 500 was up 5.5%. The day before, it was down 2% because the market was optically, I believe, disappointed that there was no red wave from the Republicans in the midterms. So, I mean, is there any way, we don't have much time, but you just want to touch a little bit on any thoughts you might have on sort of market implications of what did and didn't happen on Tuesday night?
Tuesday. Yeah. I think it's been interesting. I think when we're recording this at the moment, the decision for the House and the Senate still hasn't been called by the US networks, which I think summarizes that it's still very, very close. And historically, the party in power has lost 4 seats, give or take, in the Senate, and can't remember, say 15, 30 seats in the House of Representatives on average. So party in power traditionally does badly. So just on that alone, Republicans should have had a reasonably good outcome. At the same time as Biden's approval ratings are very poor, inflation, the economy, everything we've just discussed should be good for the opposition party. But I think it's probably summarized by historic underperformance by the Republicans over the midterms. The fact that the race hasn't been called yet, although the House is likely to go Republican, still 50-50 in the Senate, and will likely come down to a runoff in Georgia, I think, in December.
But Charlie, is that still, though, net at this point indicating a likely stalemate?
Yeah.
That generally, for whatever reason, which you can agree or disagree about, but the market likes the stalemate?
Yeah, I think despite I think most people would say we'd like politicians to get things done, to move a planned process forwards and stuff. But historically, markets like divided government because nothing happens. And policy changing, regulations not changing is generally a good outcome for equities because there's no meddling from politicians in what businesses can and can't do. So I think what it's going to end up with is we're going to see limited further regulatory or reform action in healthcare. I think you might see a lot more noise around China. It's seemingly one thing both parties agree on is hawkishness towards China. So I think that rhetoric's likely to ramp up. What they can actually do with action remains a question. But I think it's going to be policy stalemate. You're not going to see a lot of action, and that's generally pretty good for markets. How it leads into 2024, the 2024 general election, I'm not sure. I think the one thing that came out of the midterms is that Mr. Trump did not have a good day. A lot of his candidates that he endorsed lost or massively underperformed. How that plays out into his likely announcement next week that he's going to run for president again versus Ron DeSantis, who you'd argue would be the favored candidate for the Republicans, given how well he performed in Florida. That remains to be seen. Does Joe Biden run again? He turns 80 years old next week. Will he want to run? I'm not sure. We'll have to see. But as you said, it kind of culmination of with the midterms and CPI, a very, very busy 2-3 week period for markets.
Yeah. And we probably will shoot another video in the not too distant future, which might cover some of those topics, what implications what's been happening in cryptocurrencies might have. We've also got, which is more, something that we would probably feel a little bit more comfortable commentating on, US results season for the retail sector, which, is important because the consumer stocks kind of led the way in the downturn earlier in the year. Stocks like Nike, which we're great fans of for the long term, got really hit very hard in the earlier part of this year. Obviously, big rally yesterday. So, I think that might be, outside of those macro factors, the next big thing for markets, just how far we've got with retail inventory management, destocking, restocking, consumer behavior. Are they trading down price wise? So that's going to be very interesting, isn't it, over the next few weeks? So I think we'll leave it there. Been good to catch up, Charlie, as always. A lot of topics to discuss. Thanks for your input, as ever, on the politics and getting into the weeds with the Fed. Obviously, we will try to keep people updated. As Charlie said earlier in the video, we have been pretty cautious. We have had quite a lot of cash this year. We have been putting little bits of that cash to work in recent weeks, which is the first time actually in some while we've done that. So we've been somewhat less bearish about markets in general. Still feel there is a need to be careful. Certainly not out of danger for markets yet completely, but there is a slightly more positive feel to markets, notwithstanding, of course, what happened yesterday, which was an unbelievably strong day for markets. So we will keep you informed, as this situation evolves. So thank you very much for your time.